At 3:47 p.m. on a quiet Friday afternoon, a single number flashed across a screen. And 8 of the world's most powerful banks realized they had just lost control. This story does not begin with hype. It begins with a clock. Because while the market was watching prices, while headlines argued inflation, rates, and politics, a hidden rule, buried deep inside commodity exchange law, finally snapped into place. And when it didn't just move silver, it activated a kill switch. Here's why that matters. Silver crossing $67 wasn't bullish, it wasn't speculative, it wasn't even emotional. It was mechanical, a pre-programmed consequence of decisions made years ago, decisions most investors never knew existed. And now, there's no rewind button. For the next 72 hours, 8 systemically important banks were given 3 choices. None of them were good, and all of them lead to the same place. This isn't about people suddenly wanting silver. This is about a mathematical trap closing, exactly as designed. A trap set after the last crisis, triggered by fear of another, and now threatening to cause the very thing it was meant to prevent. Because when silver hit that number, $67, something changed permanently. Margins didn't just increase, algorithms didn't just adjust, emergency protocols didn't just prepare, they executed. Banks that had quietly controlled silver for years suddenly faced an impossible requirement. Either post nearly $1 trillion in collateral, or buy silver that does not exist, and they have a deadline. The reason you haven't heard about this yet is simple. These systems were never designed for public understanding. They were designed to operate silently, until the moment they couldn't. What you're watching now isn't a rally, it's a countdown. A countdown triggered by a rule most traders have never read. At a price level Wall Street hoped would never be reached, in a market where paper promises finally collided with physical reality. In this video, we're not speculating, we're not predicting, we're walking through documented rules, timestamps, filings, and math. And by the end, you'll understand why $6,700 may go down as the most dangerous number in global finance since 2008. Because once a kill switch is pulled, the system doesn't ask permission. And next, I'll show you exactly where that switch was hidden, and why crossing it trapped 8 banks at the same time. The most dangerous rules in finance aren't announced, they're buried. To understand why $67 mattered, you have to go back, not to a headline, but to a footnote. In early 2023, while markets were distracted by inflation theatrics and rate hikes, the Chicago Mercantile Exchange quietly updated a section of its rulebook. No press release, no CNBC segment, no warnings, just a revision. It was called Rule 4.07b, the Enhanced Margin Liquidation Protocol. The language was dull, legal, almost hypnotic. But the logic behind it was ruthless. It said this: if a systemically important participant holds a short position that moves too far against them, adjusted for volatility and leverage, they must post 100% cash collateral within a fixed time window. No negotiation, no extensions, no discretion. And here's the critical part. The trigger wasn't a price, it was a ratio. A percentage move relative to where those shorts were originally placed. Between 2020 and 2023, the largest banks in the world built massive silver short positions. Not at $60, not at $40, but around $22 to $25 per ounce. They believed silver could be controlled forever. Paper contracts, rolled positions, synthetic supply. It worked until it didn't. Because Rule 4.07b wasn't designed to stop volatility. It was designed to stop panic. Regulators remembered March 2020. They remembered how close the system came to failing when too many traders demanded physical delivery at the same time. So they created an automated tripwire. If prices ever moved far enough, fast enough, the system would force liquidation early, before positions became impossible to unwind. But there was a flaw. That rule assumed that banks could always close positions. It assumed supply would be there. It assumed paper and physical were interchangeable. They weren't. Here's where the math gets lethal. A 285% move above the banks. Average short entry, adjusted for leverage and regulatory buffers, placed the effective trigger right around $67.25 per ounce. Not $100, not $150, 67. So when silver crossed that level on a Friday afternoon, the system didn't notice. It responded. Margin engines recalculated. Risk models flipped states. Clearing members issued automated notices. And suddenly, 8 banks were no longer managing positions. They were racing a clock that doesn't care about confidence, power, or reputation. Because Rule 4.0 doesn't ask who you are. It only asks whether you can pay. And now, those banks must either produce cash or buy silver into a market where physical supply is already vanishing. Next, I'll show you who those 8 banks are and why their losses aren't isolated bets. but pressure points connected to nearly $1 trillion in global derivatives. That's when this stops being about silver and starts being about the entire financial system. When one bank is trapped, it's a problem. When 8 are trapped together, it's a system. By mid-December, regulatory filings confirmed what risk desks already knew. This wasn't a theoretical breach, it was active, live, and spreading. According to the latest bank participation data, 8 global institutions were sitting on a combined 421 million ounces of short silver exposure. Not paper losses, real mark-to-market damage. JP Morgan, HSBC, BNP Paribas, UBS, Deutsche Bank, Citigroup, Goldman Sachs, and one more quietly positioned just below the radar. Each of them believed the same thing for years. Silver could always be rolled, deferred, or settled later. But Rule 4.07b doesn't allow later. At $67 per ounce, their combined unrealized losses pushed past $18 billion. But that number is misleading, because those shorts aren't isolated trades. They are hedges. They sit underneath vast derivative structures tied to gold, commodities, inflation swaps, pension allocations, and sovereign hedging programs. When the silver shorts move, they don't just hurt P&L, they destabilize balance sheets. The real exposure isn't $18 billion. It's closer to $900 billion in linked contracts that rely on silver remaining controllable. That's why this moment is different. In the past, when silver approached dangerous levels, banks used a simple playbook: dump paper, crash price, reset sentiment, and it worked for years. Every breakout attempt ended the same way: a sudden flood of futures contracts, a sharp reversal. Silence. But December was different, because this time, when paper was dumped, the market didn't break. Buyers absorbed it. Industrial users, sovereign funds, entities that don't trade sentiment, they consume metal. That was the signal. Because once physical demand absorbs paper suppression, the leverage flips. The banks didn't just lose control of price, they lost control of time. Every hour that passes now makes their position worse. Every day that silver holds above the trigger level compounds collateral requirements. And the most dangerous part? They all face the same deadline, which means liquidation won't be staggered. It will be synchronized. 8 institutions forced to act into the same shrinking pool of physical metal. This is how squeezes turn violent. Not because of greed, but because of coordination without cooperation. In the next part, I'll show you exactly why the old suppression strategy finally failed, and how physical demand quietly overpowered unlimited paper supply. That's the moment the illusion broke. Paper silver only works when nobody asks for the metal. For more than a decade, the silver market ran on a simple illusion: unlimited supply, as long as delivery was never required. Banks didn't suppress silver by selling bars. They sold promises, futures contracts, options, swaps. Every time silver threatened to break out, tens of thousands of paper contracts would appear out of nowhere, dumped in minutes, sometimes seconds. No mining surge, no vault inflow, just synthetic supply. And because most participants traded price instead of delivery, it worked. Until December 2025. Because something changed beneath the surface, quietly, relentlessly. Physical demand didn't spike overnight. It accumulated. China's solar manufacturing alone began consuming nearly 1 billion ounces a year. AI data centers added a brand new category of demand: servers, cooling systems, high-efficiency circuitry. India's imports surged to record levels as physical silver replaced failing currencies. This wasn't investor speculation. This was consumption. Silver wasn't being hoarded, it was being used. So when banks executed their usual Friday afternoon suppression, dumping tens of thousands of contracts, something unprecedented happened. The price dipped, and then it came back. Buy orders absorbed every ounce of paper offered. Not ETFs, not hedge funds, manufacturers, governments, entities that need silver to function. At that moment, the suppression model broke, because paper supply only works when physical demand is passive. December 13th proved it wasn't. When silver surged back above $67 and held there into the close, every algorithm watching liquidity flagged the same issue: paper selling no longer moved the market. That's when clearinghouses escalated, margin requirements recalculated, collateral thresholds updated, emergency notices went out, and the 72-hour window began. Here's the brutal reality: banks can't suppress what they can't deliver, and now for the first time in decades, physical demand exceeds synthetic capacity, which means every attempt to cap price only creates more urgency, more buying, more stress, more collateral calls. This is why the old tricks failed. Not because banks suddenly lost influence, but because the metal itself became scarce. Silver crossed from being a financial instrument into being a strategic resource, and markets behave very differently when scarcity is real. In the next part, we're going inside the vaults. Not opinions, not theories, actual inventory numbers. Because once you see how much silver is actually available, and how fast it is disappearing, you will understand why the bank's options are no longer choices, they're consequences. Everything changes when you open the vault doors, because price doesn't matter if the metal isn't there. On paper, the silver market still looks liquid. Charts move, contracts trade, ETFs update balances, but inside the vaults, the place where delivery actually happens, the story is terrifying. There are two kinds of silver stored in exchange vaults, eligible and registered. Eligible silver is metal that exists, but isn't for sale. It belongs to someone who has no obligation to deliver it. Registered silver is the only metal that matters. It's the inventory available to settle futures contracts. Think of registered silver as what's on the shelf. Eligible silver is someone else's property sitting in the warehouse. As of mid-December, registered silver had fallen to roughly 47 million ounces. Let that sink in. Just 2 years ago, registered inventory was over 300 million ounces. That's an 86% collapse, and the rate of decline is accelerating. In 2025 alone, silver left registered vaults at an average pace of over 800,000 ounces per day, every single day. At that speed, the vaults hit zero in weeks, not years. Now, compare that to what's required. December and January delivery contracts represent over 500 million ounces of potential demand. 500 million ounces, chasing 47. That's not a tight market. That's a mathematical impossibility. For perspective, during the famous Hunt Brothers squeeze in 1980, registered inventory never dropped this low. During the 2020 panic, it never dropped this low. This is the lowest registered silver inventory in modern exchange history, which means if banks attempt to close even a fraction of their short exposure through physical delivery, the system fails instantly. There simply isn't enough metal. This is why regulators are nervous. Because exchanges can survive price volatility, they cannot survive delivery failure. Once an exchange admits it can't settle contracts with physical metal, confidence evaporates. And confidence is the only thing holding paper markets together. In the next part, I'll show you the moment regulators blinked, the emergency filing that confirms they know exactly how bad this is. It's public, it's time-stamped, and it changes everything. Regulators don't panic publicly, they panic on paper. And on December 16th, the paper trail appeared. Buried inside an emergency procedural update, the kind almost nobody reads, was a quiet but explosive change in settlement language. No press conference, no headlines, just a revision timestamp. The filing expanded the exchange's authority to delay, substitute, or cash settle silver contracts under exceptional market stress. That phrase matters because exceptional market stress is regulatory code for one thing only: insufficient deliverable supply. In plain English, they're preparing for a scenario where metal can't be found. This wasn't theoretical planning. The timing gives it away. The update came 72 hours after silver failed to break down below $67, exactly when margin models began flagging compounding risk, exactly when vault outflows accelerated. That's not coincidence, that's reaction. Behind the scenes, clearing members were already asking uncomfortable questions. What happens if multiple banks stand for delivery at once? What happens if industrial users refuse cash settlement? What happens if eligible holders don't volunteer their metal? Those questions have answers regulators don't like, because forced cash settlement doesn't solve scarcity, it confirms it. The moment an exchange admits cash is equivalent to metal, silver stops being a commodity and becomes a two-tier market: paper silver and real silver. Historically, that split never ends quietly. It ends with price repricing, violently, as physical metal detaches from synthetic claims. That's why this filing matters more than price charts. It tells us the exchange isn't confident it can perform its core function: delivery. And when trust breaks at the settlement layer, everything above it cracks. ETFs, derivatives, structured products, pension hedges, they all rely on one assumption: that somewhere, somehow, the metal exists. December shattered that assumption. In the next part, we zoom out, beyond silver, because this isn't just a metal story anymore, it's a systemic liquidity story. Silver is simply the first stress fracture, and history is very clear about what comes next when the smallest market breaks first. When the smallest market breaks first, it's never the end of the story, it's the warning. Silver is not a giant market. That's exactly why it matters. At roughly $1.5 trillion in total annual turnover, silver sits at the edge of the global commodity system, small enough to be pushed around, but large enough to connect everything else: gold, energy, credit, currencies. Think of silver as the canary market. It reacts first because it has the least margin for error. And once it breaks, pressure migrates outward. Here's what happens next. Not speculation, but sequence. When silver volatility spikes and delivery risk rises, banks don't isolate the damage. They de-risk everywhere. That means commodity desks reduce exposure across metals. Liquidity is pulled from energy hedges, credit spreads widen as collateral quality is questioned, dollar funding tightens as margin calls increase. This is already visible. Over the last 2 weeks, repo stress indicators quietly ticked higher. Commodity volatility indexes moved before equities did. Cross-currency basis, swaps began flashing strain, the same early signals seen before every modern liquidity event. Silver didn't cause this. Silver revealed it. Because the real problem isn't metal scarcity, it's leverage density. The global system is stacked with claims layered on top of other claims, all assumed to be liquid, all assumed to be deliverable, all assumed to be hedged. Silver just exposed how fragile those assumptions are. When one market can't settle physically, counterparties start questioning every promise. That's how confidence unravels. Not in a crash, but in a withdrawal. Liquidity doesn't disappear, it steps back. Banks stop making markets as tightly. Bid-ask spreads widen. Volatility feeds on itself. And policymakers hate this phase the most because it's invisible to the public until it's everywhere. By the time headlines appear, the damage is already locked in. This is why officials are watching silver so closely, not because of the price, because of the precedent. If silver reprices due to physical scarcity, every other commodity with tight supply suddenly has permission to do the same. Copper, uranium, platinum, even energy. And once physical reality reasserts itself, paper control never fully returns. In the final part, I'll show you what historically follows this exact setup, the playbook institutions use when suppression fails, and what signals confirm the transition from control to repricing. This is the part most people miss, because it happens quietly, right before the move everyone talks about later. When control fails, institutions don't fight the market. They step aside. This is the phase almost nobody recognizes in real time. There is a moment, brief, quiet, and incredibly dangerous, when suppression doesn't collapse loudly. It simply stops being enforced. Not because banks admit defeat, but because defending the price becomes more expensive than letting it go. This is that moment. Historically, when a commodity breaks free from paper control, institutions follow the same playbook. First, they reduce visible shorts quietly, not all at once, not publicly. Second, they widen spreads, making it harder for retail and smaller funds to trade efficiently. Third, they allow price discovery to happen during low liquidity windows, overnight sessions, holidays, thin volume periods. That's how repricing begins without triggering immediate panic. We've seen this before. Gold in the early 2000s, oil in 2007, nickel in 2022. In every case, the signal was the same. Price stopped responding to suppression. Volatility shifted regimes. Physical premiums detached from futures. Silver is now checking every box. Premiums on physical bars are rising even when futures stall. Delivery delays are increasing quietly. Wholesale buyers are locking supply months in advance. These are not retail signals. They are institutional behavior changes. And the most important signal? Silence. No official denial, no reassurance. No, everything is functioning normally statements, because saying that would require proving it. Instead, the system is preparing to reprice without admitting failure. This is how paper markets retreat. Not with explosions, but with gaps. One day, silver trades like a controlled asset. Then suddenly, it trades like a scarce resource. And once that transition happens, there is no rewind button. Because repricing isn't driven by belief. It's driven by necessity. Industry still needs silver. Energy still needs silver. Technology still needs silver. And scarcity doesn't negotiate. Silver was never the destination. It was the stress test. What breaks next will be larger, slower, more political. But silver will be remembered as the moment the system showed its hand. Not because the price went up, but because delivery stopped being guaranteed. That's when markets stop being theoretical and start being real.